Imagine walking into a bank, fully expecting to be approved for your dream home, only to be slapped with a reality check that will cost you the equivalent of a luxury sports car. A woman named Patricia recently lived this nightmare when she walked into a mortgage lender's office carrying a credit score of 621. The loan officer gave her the news she was dreading. She would qualify for a mortgage on a $350,000 home, but she would be saddled with a brutal interest rate of nearly 7% on a 30-year loan. Over the life of that mortgage, her mediocre credit score was going to act as a massive, invisible tax, costing her upward of $180,000 more in interest compared to a buyer with excellent credit. Desperate, Patricia asked if she could take 90 days to improve her score before locking in that terrible rate. The bank smiled politely, warned her that credit building is a painstakingly slow process, and suggested she shouldn't hold her breath for a miracle. Exactly 93 days later, Patricia returned to that exact same desk. Her credit score was now a staggering 761. The change was so impossibly drastic that the loan officer actually asked if she had written down the wrong social security number. She hadn't. By understanding a hidden, perfectly legal mechanism deeply embedded in the credit scoring algorithm, Patricia bypassed years of waiting. That 140-point jump saved her over $215,000 in lifetime interest on her mortgage. Today, we are pulling back the curtain on exactly what Patricia learned. You have likely been fed the standard advice: pay your bills on time, keep balances low, and wait decades for your score to mature. While technically true, this advice is dangerously incomplete. The slow path keeps you trapped in the fair credit zone, directly funneling more interest revenue to banks. Stick around, because by the end of this video, you will possess the financial blueprint the banking industry desperately hopes you never find. To understand how to legally manipulate your credit score, you first need to understand what that 3-digit number actually represents. At its core, your credit score is simply a statistical prediction. It exists to tell lenders how likely you are to default on a debt within the next 24 months. The algorithm compares your financial behaviors to millions of other consumers, heavily weighing specific factors. The largest chunk of your score, roughly 35%, is based on your payment history, which simply asks if you have paid your bills on time. The second largest factor, making up about 30%, is your credit utilization, which measures how much of your available credit you are currently spending. However, the key to Patricia's massive success lies in the third largest factor, the length of your credit history. This category accounts for about 15% of your total score and evaluates the age of your oldest account, your newest account, and the overall average age of all your accounts. Most people mistakenly believe that credit age is strictly tied to the passage of time, assuming that if you got your first credit card at 18 and you are now 30, you simply have 12 years of history and cannot do anything but wait for it to grow. This assumption is entirely wrong, and that misunderstanding is precisely where the most powerful loophole in the financial industry exists. This brings us to the exact strategy Patricia used: authorized user trade lines. When someone adds you as an authorized user on their existing credit card, that account's entire history is instantly imported onto your personal credit report. This means the account's age, its flawless payment history, its high credit limit, and its low utilization become yours, acting as if you had been a co-owner of that account since the day it was opened. Consider Patricia's situation. Her mother had 3 credit cards boasting perfect payment histories, utilization rates under 5%, and a combined age of over 40 years. Patricia simply became an authorized user on all 3 of these cards. Within just 2 billing cycles, her incredibly thin credit file looked robust and deeply established. Her score skyrocketed by 140 points. The beauty of this strategy is that it works across different scenarios. Take Marcus, a 24-year-old with a dismal 589 credit score due to some missed college payments and a maxed-out store card. Car dealerships were quoting him predatory auto loan rates above 14%. His grandfather, however, had credit cards dating back to 1987 with combined limits of over $60,000 and spotless payment records. By adding Marcus as an authorized user to his 2 oldest cards, Without ever handing Marcus the physical plastic, Marcus's average account age shot from 2 years to nearly 19 years in just 60 days. His available credit tripled, his score jumped to 697, and he qualified for a 6% auto loan. That 10-minute online favor saved Marcus nearly $5,200 in interest on a $25,000 car loan. If you want to execute this safely and legally, the details are critical. First, the account you are attaching yourself to must be in immaculate standing. It needs a perfect payment history, a low utilization rate, ideally under 10%, a high credit limit, and a long history. Any missed payments by the primary account holder will actually damage your score instead of helping it. Second, you need a willing partner, usually a close family member or friend. Remember, they do not have to give you a physical card or access to their money. They are simply lending you their good reputation. It is also important to note that not all banks report authorized users to the 3 major credit bureaus. Major players like Chase, American Express, Bank of America, Discover, and Capital One generally do, but smaller credit unions might not, so verify their policies first. Once added, you will see the impact in just 1 to 2 billing cycles. Furthermore, this strategy is incredibly low risk for the primary account holder because they can remove you as an authorized user at any time, which will eventually cause the account to drop off your credit report entirely. You might be wondering if this is actually allowed. The answer is an unambiguous yes. The authorized user system is an intentional, explicitly legal feature recognized by credit bureaus and incorporated into both FICO and VantageScore models. It was originally designed to help spouses share credit histories, but it was quickly realized that anyone could use it to help a family member. While FICO has slightly adjusted its algorithm over the years to reduce the extreme impact this used to have, the benefits remain massive. The only major hurdle is that some manual mortgage underwriters may choose to ignore authorized user accounts, though automated underwriting systems, like the one Patricia's lender used, typically accept the inflated score at face value. While authorized user trade lines are the most powerful tool, the credit system hides other mechanisms that you can exploit today. 1. The Utilization Timing Trick. Your credit utilization makes up 30% of your score, and while sophisticated advice suggests keeping it under 10%, the absolute optimal target is actually between 1% and 3%. Most people assume that as long as they pay their credit card bill in full by the due date, they are in the clear. This is a massive misconception. Credit card companies report your balance to the bureaus on your statement closing date, which happens before your payment due date. If you charge $2,000 on a card with a $3,000 limit, your credit report will show a penalizing 67% utilization rate, even if you pay it off completely a week later. The fix? Pay your balance down to roughly $50 just before the statement closing date. This ensures a utilization rate of under 2% is reported, which can boost your score by 20 to 40 points within a single billing cycle. 2. The Denominator Hack credit limit. Increases utilization is just a fraction, your balance divided by your limit. Instead of just focusing on keeping your balances low, you can attack the other side of the math by actively increasing your limits. Many credit card issuers, particularly American Express, allow you to request credit limit increases online using a soft pull, meaning it will not damage your credit score with a hard inquiry. If you owe $2,000 on a $5,000 limit, you are at 40% utilization. If you get that limit doubled to $10,000, your utilization instantly drops to 20% without you changing your spending habits at all. You should strategically request limit increases on your cards every 6 to 12 months. 3. Strategic account management and rapid rescoring. Conventional wisdom tells you never to close an old account. This is only partially true. You should absolutely keep your oldest credit card open forever to anchor your credit age, but closing newer, useless store cards can actually increase your average account age by removing the newer data points, dragging the average down. Furthermore, if you are actively applying for a mortgage and need a fast boost, ask your lender about rapid rescoring. This is a backdoor method only available through lenders that forces credit bureaus to update your file in a matter of days based on new proof, like a receipt showing you just paid off a balance. This bypasses the normal monthly waiting period and can trigger a 50 to 80 point jump mid-application. Before you rush to implement these tactics, you must avoid the common mistakes that sabotage them. Never piggyback on an authorized account that has a history of missed payments or high utilization, as you will inherit those toxic traits. Do not actively apply for new credit cards while trying to optimize your score, because the hard inquiries and the addition of a brand new account will drag your score downward. Avoid being inconsistent with your utilization timing. A single month of forgetting to pay before the closing date can undo your hard work. Finally, do not be impatient. These strategies take 1 to 2 full billing cycles to reflect on your report. Your exact approach depends on where you stand today. If your score is below 650, your priority should be the authorized user strategy. Find a trusted family member with an old, pristine account and ask to be added. At the same time, dispute any inaccurate negative items on your report and aggressively pay down balances before statement closing dates. If you are sitting between 650 and 720, you are in the prime optimization zone. Ask for credit limit increases across all your cards, master the statement closing date timing trick, and consider piggybacking if your credit file is relatively thin. If your score is already above 720, you are generally in great shape, but optimizing your utilization timing and limits can push you closer to 780, securing you the absolute best interest rates available. Regardless of your score, everyone should be checking their free credit reports annually to catch and dispute errors, which are shockingly common and can ruin your loan eligibility. Ultimately, you need to realize that the credit scoring matrix was built by lenders to protect lenders and to dictate how much they can charge you. They have zero incentive to teach you these loopholes because a confused, patient consumer is a profitable consumer. The difference between someone who knows these mechanical rules and someone who doesn't is hundreds of thousands of dollars in lifetime wealth. You are not cheating the system. You are simply playing by the actual rules instead of the simplified stories the banks sell you. Patricia used this knowledge to permanently alter her financial destiny, saving enough money on her mortgage to fund her eventual retirement. The hidden fast lane has always been there. Now that you know how to use it, the next move is yours. Now you know the rules. What you build with this knowledge is up to you. If this strategy changed how you view the financial system, hit the like button and subscribe for more wealth building mechanics. See you in the next video.